Welcome back to Risks and Rewards, the weekly discussion where I get to speak with the legend himself, John Authers of Bloomberg Opinion, about what we see as the main market stories, the main risks, the main potential rewards, kind of hanging out there. And John, you and I both honed in on the same theme as we are wont to do when it comes to the main market story, which is there's nothing going on, the summer stupor, except that everything just keeps climbing to new highs. And this in and of itself is notable.
Yes, and generally, sometimes it's a cause for market commentators to resort to saying it's quiet, but is it too quiet? But yes, extremely.
Gotta talk about something.
Yes, extremely low volatility is a problem. Also, as you raised the issue of the fact of the way in which we are almost in this anesthetized quiet period, you could almost call it a taper stupor. You can trademark that one rather than a taper tantrum. This time around, the Fed started talking very vaguely about tapering, and bond yields actually fell rather than rose. And that move is still in effect even after the Fed rode things back a little at the beginning this week. And meanwhile, as you say, there is no sense of risk at all in the stock market.
I like that you call it a taper stupor, because if you talk about tapering, which you hear some talk of tapering, it's vastly in contrast to what you actually see the Fed doing. If you took a look at the Fed's balance sheet this week, it rose to a new record high of $8.1 trillion. If they start paring their purchases, it doesn't mean they're going to start shrinking their balance sheet. And frankly, Bloomberg Economics doesn't see it coming down before hitting well above $9 trillion and then taking a decade to get back down to normal levels. So yes, this is supporting valuations, but it seems like no one's worried about anything. I mean, really, genuinely anything. I asked a fund manager a little bit ago, what are you worried about? He said, really nothing. I mean, it was basically like, let's worry about solar flares.
And that in itself is actually the single most worrying thing. You similarly find it with sentiment surveys. It's when you get really strong levels of complacency that you need to be most concerned, because it means that people aren't aware of the risks that are out there. It's always the risks that you've planned for, that you're worried about in advance, that you can deal with, and it's the ones that really take you by surprise that hammer you, that create damage. I think on one other issue on the taper, I think it's worth also talking about the fact that there are, when we look at the potential for supply of bonds coming up, it now looks again as though the chances of spending a lot of money on infrastructure have risen again since we last spoke. I think it's fair to say, and the chances of raising some taxes to pay for it have fallen. So you do arguably also get into the era of the risk of tapering by default, where the Fed just doesn't buy quite as big a proportion of the new issue, which gets into very abstruse logic. But whether we're sleepwalking into slightly more of a taper in future than we are currently expecting, that there will be some form of drag coming from the current spending plans.
That's an interesting idea, especially in light of the dueling messages out of the Federal Reserve. So last week we got the hawkish Fed meeting, so hawkish that they moved up dots, and dots got everybody worried that maybe they would raise rates as soon as 2023. Jay Powell did sufficient damage control this week in his testimony before the House, basically came out and said, we still see it as transitory, it being inflation, and we're not going to move anytime soon. And he's the one to listen to. I mean, New York Fed, the former New York Fed president, Bill Dudley, came on television and he basically said, don't listen to any of the regional Fed presidents. The only people to listen to are Rich Clarida, John Williams, and of course, Jay Powell, and everybody else doesn't matter. And the leadership basically came out and said, we're going to keep the pedal to the metal. The question that I have, though, to your point is, are we going to get, if not inflation, an increase in real yields, an increase in the premium that investors charge to own full faith and credit government debt? And the problem with that is that time and again, when yields rise too much in the US, and too much, I mean, on a relative basis, you get foreign investors that flood in. And the more that dynamic just gets hammered home, the more people just feel comfortable that even if there is this drag, the US is going to look that much better and it will bring in foreign investors and that it will be sucked up. And frankly, I don't see anything to debate that, to really undermine that argument, John.
Okay. So you're asking me to try to undermine that argument.
Yeah.
Yes. I guess, okay, 2 points. I think one is that people can overlearn the lessons of the last crisis. That's it's a natural response. So, for example, Dick Cheney's famous words about how we learned under Reagan that deficits don't matter. They didn't do too much damage under Reagan for various reasons. That doesn't necessarily mean that deficits per se don't matter. I think one of the things that people have pointed out to me about the taper tantrum in 2013 is that it might have hurt quite a lot of other people around the world. It didn't hurt America at all. It was a fantastic year for the American stock market, 2013, in part because of what you were saying, that it was that was benefiting from safe haven flows. So yes, you can see arguments there. If you want to, that my best counter argument on how this will continue to attract, that we will perversely attract flows to the US and keep real yields low, would be China. Who are more interested in attracting capital than they were before, and whose bonds are being, they now have such things as Chinese green bonds, one of the more self-contradictory securities you could ever imagine. That is one of the areas where you can imagine that you've got this other pole to the global economy in China, and if the more that is seen as a valid alternative, the more you could see China beginning to have the opposite effect to the effect it had in the aughts. That at that point it was helping keep yields here in the States down. If it begins to attract capital, attract people to invest in it, it could conceivably help raise real rates here. That was my best attempt to counter what you were saying instead.
I think that
powerful effects, but that's what I can come up with as reasons.
Well, look, I think that you're right. I think that would be a big sea change. The other thing, and I think that this goes back to your earlier point, and frankly, it speaks to one of the most underplayed risks in the market right now, to get there early. And I realize it is early, but it really is the truth. People have been pricing in some fiscal stimulus, and certainly what we saw in terms of the $579 billion infrastructure spending plan that came out, that bipartisan group of Congress members were coalescing around, that seems to be a move in the right direction.
Yes.
Not big enough, though, especially over the time frame that it would get doled out over, to really move the needle dramatically in either productivity, and there were no tax hikes attached to it. So it didn't really move markets. If there is a $6 trillion addendum to it, written by Bernie Sanders to advance President Biden's agenda, and if it actually looks like it could pass, because right now that seems highly speculative. If it looked like it could pass, would that change the situation? Could you get a material shift in yields that really is not being accounted for, in part because it's spending and it's inflation, and it puts money in the hands of people who are actually going to spend it, versus just sort of putting money into bridges and roads, which frankly, I mean, we need.
Well, we need them, but the other point about bridges and tunnels is that they take quite a long time to build, and they take quite a lot of time to pay for. So both the spending and the benefits of the spending are still quite a few years in the future, and we can't help it. We're human. We're short-termist. It's not going to have that big of an effect in the short run. I certainly agree that if you really had the kind of blue wave effect that we've been thinking about ever since the Georgia Senate elections, of a really, really big emphatic shift towards spending more, redistributing more, giving money to people with a greater marginal propensity to consume, that would change things. And it would certainly mean that yields needed to go up, because you really would have changed the paradigm. My reading, not being a political pundit, my reading of what's happened in the last week is that in some ways, it more or less ensures this sort of slightly debased Goldilocks version for the future. It makes something happening much more likely, but it actually also, and this is why the progressive wing of the Democratic Party doesn't seem to be very happy about it, it makes something really dramatic less likely. It makes it easier for Republicans just to say no because they have said yes to something, and it makes it easier for people like Joe Manchin, and in fact, it's not just Joe Manchin. There are quite a few sort of fiscally moderate Democrats around. It makes it easier for the mainstream Democrats to say no to the Bernie wing. So I think, yes, it would have a big impact in a way that would probably not be great for stocks in the long run, because it would help inflation and it would raise yields. But I think it's actually somewhat less likely to happen now than it was a week ago.
I would agree with that.
Tunnel is more likely. A real paradigm shift is less likely.
On the flip side, and actually to edify your point here, and this sort of speaks to potentially lower yields than higher yields, at least in full faith and credit. I mean, credit itself, riskier credit is another story with spreads that they're all at their tightest post-crisis. There was this idea this week that we were going to get inflation from the PCE, the core PCE, right? And we were going to get personal spending that would show the shift to services from buying goods.
Yes.
It actually showed a lag. It actually showed a disappointment in the amount that people were spending. I think this is actually one of the most significant data points of the week. The idea here that people have this mysterious package of savings that they're going to put out there, and they're going to go buy airplane tickets, and they're going to go out to eat. And it certainly looks like they're going out to eat. But those expenditures are not overcoming the decline that you're seeing in goods purchases. And this really speaks to people's willingness to spend, especially as prices go higher.
Yes.
For commodities and for certain base inputs. The idea here, people spend less, and it sort of speaks to this disinflationary trend of higher oil costs, of higher wages, et cetera, that maybe has a bigger effect than people think. It's still too early, but I thought that was telling. I thought that was a really important moment.
I would agree with that. The other thing, just to amplify that, was we've had the Michigan consumer sentiment numbers today, and the Michigan expected inflation is always about 2 percentage points higher than it should be, because consumers always overestimate inflation ahead. But it has come down. It does show a sort of peak in concern about inflation among consumers, which is another application of that point, that they're not rushing to go and buy stuff because they're terrified that inflation is about to take off. So yes, I agree that it's a very delicate needle, and there is still the fact that an awful lot of money has been printed recently, and we all did economics 101 that will, all other things equal, ceteris paribus, be inflationary. But the pendulum has definitely shifted towards deflation, or towards less inflation in the last week.
All right. Well, just in the interest of time, I do want to close with this idea of the overplayed, underplayed risks. Why don't you start?
Okay. For an overplayed risk, I'm going to give you from home. I'm going to give you Britain and Brexit. I still think Brexit was a terrible idea. There was never any way, certainly economically, there was never any way we were going to make ourselves better off by voluntarily leaving a very good trade deal with by far our biggest trading partner. That said, British stocks are now cheaper than American ones. They're cheaper than continental European ones. The gap is far wider than it was 5 years ago. Sterling is 10% cheaper. There was, I illustrated with some charts earlier in the week, there was this massive one-off devaluation on the night of the referendum that has absolutely stood. So in my opinion, despite continuing to be one of the many Brits who still hate what the majority of the country decided to do, I think the market is now overestimating the problems, the risks for Britain going forward. It's a bad idea, but it's not that bad an idea, and it's been more than adequately discounted.
Yeah, and especially with the pandemic, with the UK actually having a better response than the EU. I will just say one last thing, in an interest in time, the one sort of underplayed a potential opportunity. This was an argument from Mike Mayo of RBC. He came out and he was talking about the banks, and he was talking about the $140 billion of distributions in dividends and buybacks from the banks. That was likely the 6 biggest banks after the stress tests. And he was saying that at this point, the banks have a higher yield. Their stocks have a higher yield than junk bonds on average. And these are behemoths. And he was saying that the yield was actually about almost nearly 8%, that you're getting 2, 3, 4 percentage points more in some cases than certain junk bonds. And that it seems like it would just make sense. And he doesn't understand people's reticence at this point. I thought that really shows where we are.
You get all
stock bond valuation.
So you get all of JP Morgan's or B of A's chances for growth on top of that, rather than an ideal scenario of getting your principal back on a lousy junk company. Yes,
with record low spreads. I just thought that was a fascinating argument, and you'd have to dig in as far as the growth prospects go, because people are worried about loan growth and the flattening yield curve. But people, he was saying we're not adequately pricing that in. That dividend yield, sort of relative valuation. I thought that was fascinating.
I can only agree. Good old Mike never ceases to amaze.
Agreed. Anyway, unfortunately, we're out of time, but we will be back next week, and it's always great speaking with you, John.